Hey people, I welcome you back to Caroline's Online Academy. We are solving previous year questions and sample paper questions from the chapter Dissolution of Partnership Firms. The sample question papers that are released by CBSE. And currently we are doing the journal entry based problems from that chapter. And we have a question that was part of the 2019-20 sample question paper for 4 marks. Let's go ahead and read it and solve it. Okay. The firm of R, K, and S was dissolved on 31st March 2019. Passed necessary journal entries for the following after various assets and other than cash and bank, obviously, and third-party liabilities had been transferred to realization account. K agreed to pay off his wife's loan. Total creditors, blah, 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 blah. Furniture costing, okay. A machine that was not recorded in the books was taken over by K at rupees 3,000, whereas its expected value was rupees 5,000. Okay. The firm had a debit balance of 15,000 in the profit and loss account on the date of dissolution. It seems easy. Let's go ahead and solve it. The first transaction is K agreed to pay off his wife's loan of rupees 6,000. So K agreed to pay off his wife's loan. Now, wife's loan is a third-party liability. The partner's wife is also a third party. So wife's loan is a third-party liability. If a third-party liability is settled, realization account will be debited. Now, which account will be credited? If you pay cash to settle the account, bank account will be credited or cash account will be credited. If a partner takes over a liability, then the firm is liable to pay the partner that amount. Am I right or not? So what will be credited is partner's capital account. So here K takes over his wife's loan, and therefore the journal entry is realization account debit to K's capital account. K's wife's loan taken over. And the amount was rupees 6,000, so we're going to write 6,000 here. Moving on to the next transaction, my dear children. Total creditors of the firm were 40,000. Creditors were 10,000, were given a piece of furniture costing 8,000 in full and final settlement. Remaining creditors allowed a discount of 10%. Whenever you see such lengthy sentences or lengthy adjustments where they are dividing a particular asset or a liability into two, all I tell you is, like I told you earlier, is divide it, okay? So the total creditors are 40,000. Out of this, creditors worth 10,000 were given a machinery for 8,000 in full and final settlement. So if a liability takes over an asset in full settlement, what happens, my dear children? You don't pass any journal entry. It's no entry. The reason being, when liability settled, realization account will be debited, and when asset goes out of business, realization will be credited. So even if you pass a journal entry, the journal entry is going to be realization account debit to realization account. So it actually does not affect the books in any way. So you don't pass any entry. The remaining 30,000. Out of 40,000, 10,000 was settled by giving up a furniture for 8,000. Or you might wonder, we only give up a furniture for 8,000. Should I do past entries for the 2,000 or something like that? No, you don't have to, because they clearly mentioned that it has been settled in full and final settlement. For the 10,000, the creditors agreed to take the furniture for 10,000 rupees. The book value of the furniture is 8,000, but still they agreed to take it for 10,000. In final settlement, they've taken over. The remaining creditors allowed a discount of 10%. So remaining creditors are 30,000. Out of that, the discount will be 3,000, 30,000 10%. So you are paying 27,000 to the remaining creditors. So the journal entry will be what, my dear children? The journal entry will be a liability settled, and therefore realization account will be debited. The same, it is settled by paying cash to the creditors. So bank account will be credited. Bank is an asset. When you settle, pay, bank reduces, and therefore asset reduces. Now you have to credit it. Creditors settled. And the amount that you paid is 27,000. For the 8,000, you don't have to pass journal entry. As I told, that is no entry. For the remaining 30,000 creditors, they gave us a discount of 10%, and therefore we are passing a journal entry for 3,000 rupees. Third one, a machine that was not recorded in the books was taken over by K at 3,000, whereas its expected value was 5,000. So now they've given two values in the adjustment, my dear children. Now, which number is important to us? The value at which it was taken over. We are not bothered about what its expected value was, what its book value was. We are not bothered about any of that. We are only bothered about the value at which it was taken over. The value at which it was taken over was 3,000. So we'll pass journal entry for that. Now, when you realize an asset, realization account will be credited because it's income from the firm. And if you sell the asset and get money, then bank account will be debited. Whereas here, you're not selling the asset and getting the money. The partner is taking over the asset. So partner's capital account will be debited because the liability of the firm towards the partner is reducing. He's taken an asset from the firm. And therefore, partner's capital account will be debited. So the journal entry is case capital account debit to realization account. Unrecorded asset taken over. Now, whether the asset was recorded or unrecorded does not matter, my dear children. Understood or not? So the amount is 3,000 because we are only supposed to account the value at which the asset was realized. Understood? Not the value, expected value or the book value. That doesn't matter to us. Understood? The firm had a debit balance of 15,000 in the profit and loss account on the date of dissolution. Profit and loss account can be a reserve or an accumulated loss. If the profit and loss account has a credit balance, it's a reserve. If the profit and loss account has a debit balance, it is a accumulated loss. Understood? So here they say that the profit and loss account had a debit balance of rupees 15,000. So it's an accumulated loss. This accumulated loss has to be distributed amongst partners in their old profit sharing ratio, which happens to be equal in this question as they have not mentioned any specific ratio. The old profit sharing ratio is going to be equal. And the journal entry for that would be for the partners RKMS. Am I right? So when you say distributing losses to partners, the liability of the firm towards the partners reduces, and therefore partners' capital account will be debited. So R's capital account debit, K's capital account debit, S's capital account debit to realization account. Oh, sorry. Not realization account, my dear children. This is the accumulated loss, right? So to profit and loss account. To profit and loss account. Understood? So debit balance of P&L account distributed. Or accumulated loss written off. Anything is fine. What is the amount, my dear children? 15,000. So we will distribute it equally as the profit sharing ratio is equal. 5,000, 5,000, 5,000. All right. So with this, we have come to the end of this video, my dear children, and we have two more problems based on dissolution, and I'll be doing that in the upcoming videos. You people take care, have fun, share, subscribe. Some teachers are watching it, you can share it with your students. If your students are watching it, you can share it with your friends. It might help someone. That's what I'm telling.